So if you want to quickly jump to that under your meeting controls, then you have the option. If you can just say, I see it, that would be great. That way I can know that if you have a question, you know where to go. You can go ahead and type it in. Oh, thank you, Cheryl. Excellent, I see it. Very good. You can also direct it privately to me if you care to. So that's another option. So it's not a public display, so that's perfect.
Yeah.
Excellent, thank you. All right. Excellent. All right. So we're going to give it a couple more minutes just because I'm scheduled from 2:05 to 2:55, I believe. So I just wanted to be respectful of that window of timing. As we're waiting for these first couple of minutes, I did want to real quick share with you, everyone who's on the line, if you are interested in scheduling a one-on-one meeting with a financial consultant at TIAA, we would love to invite you to do that. We've actually expanded our offering, which we're really excited about. As you probably were aware or could expect, our local offices are actually not open at this time. So we do have virtual meetings that we're offering. And so what you would just simply do is you go to TIAA.org. When you do, it's going to ask for where are you looking for an appointment. And actually, let me go ahead and show you from the top. So if you go to TIAA.org/schedule now, then this is what you're going to see. So you can choose your employer. This only comes into play if we specifically have meeting dates for PGCC, which are, you know, here and there. However, I would encourage you to definitely jump out here to the virtual consultations, and you can basically at any point in time find a convenient time. The dates that are posted are within the next 30 days. So it's going to be a rolling offering of the next 30 days, kind of populating in there for you. And you can pick a date and time that works for you. All of our consultants are familiar with the Maryland Community College system and you know, PGCC, so you can definitely take advantage and, you know, pick a time and date that works for you. So at this time, you know, we would definitely welcome you to, again, book an appointment. You can see we've got a lot of them out there, so definitely take advantage, especially if you're inspired by today's presentation. And then the next thing before we get going, and I'll probably circle back and do the same demo after we conclude, but if you go to TIAA.org/Maryland CC for Maryland Community College, so Maryland CC, then there's going to be a whole host of different tools and resources. Let me go ahead and change it over. You can drop down and select your particular campus. So we're going to pick PGCC right there. And there you go. So there's some great resources. We do have some fund updates that will be taking place shortly, like the October 31st. You can take a look there and then see some particular details about your plans, the 403B and the 457. And then finally, there's a benefit fair tab here as well. So you all should hopefully be seeing that. You can actually follow that through, request an appointment, and then we do have a fun and games tab down here, so you can follow that through. And in keeping with some of today's topic, and this will be kind of our launch point for our presentation, you can also go here to Insights, developed tools and resources to start saving, financial education insights, things like that. So we do have some webinars and things like that that are coming up. So if you'd like to continue your education and discussion, then definitely I encourage you to do that. So with that, we will go ahead and get started. So again, if you have any questions, go ahead and chat them through. My name is Lisa Folco, and I'm a financial consultant. I'm actually out of the Baltimore office. So I've been serving PGCC and with TIA for the last 7 years. All right, so we'll go ahead and get started. Oh, good question. So I had a question from someone already. Do you have to have an account with TIA in order to receive a consultation? The answer is no. No, certainly. We would welcome you to come see us. I know you have some choices. I respect that. So if you have one, a plan with someone else, or you haven't started one yet, then absolutely, come see us. Those meetings are about 45 minutes long. There's no cost, obviously, and we can touch base on whatever's on your mind, whether it's retirement, is one possibility, but maybe debt reduction or saving for college or emergency savings. Those might be some of your other concerns that we can help to talk you through. So good question. All right, so again, my name's Lisa Fulco. I'm really excited to be here. And today we're talking about investing in uncertain times. I know that we're faced on a lot of sides with having to adapt, having to change. The COVID is just really an awful thing at this time, but it's making us kind of hone in on what's important, kind of stay focused, and also do make the most out of the least that we have. And so today we're going to talk about that. We're also going to talk about, again, concepts, the idea of risk tolerance, what that means, how you can kind of buffer and assure that you are diversified, you've heard that term before, and invested properly at the right time, staying in it for the long term, and also, again, leaving you with some of those take-home tools and resources. If you have any questions, I welcome you to go ahead and chat them through to the tools and to the chat box, and we can definitely make sure to get them addressed either publicly or privately as we move along. Before I get going, let me go ahead and share with you my email address, and I will also chat it through to everyone. I'm going to actually go ahead and share my email, lisa.fulco@tiaa.org. My name is Lisa Fulco, CFP, FC, and LUTCF. Phone number is 410-578-2209 and tiaa.org/schedule now. All right, sorry, had to get that out. Let's go ahead and get going. All right, so market volatility is definitely a fact. We hit on March 19th a historic low for that window of period of time, and so the market was down over 37%, upwards of almost 40%, and so the significant decline, as well as the rebound between now and then, has been just a kind of a case in point as to where to stay the course if you can, and really, don't be too caught up and too much in despair when you see market volatility, because it's to be expected, to be honest. So we're going to give you some information to really help reinforce, the fact that the stock market is going to go up. It's going to be volatile. In the past, we've noticed the ups and downs. It's been kind of more like a U, right, where there's kind of gentle ups and gentle downs and gentle ups. It's going to be more like a W. A lot of spikes, a lot of declines, even with the political and world economy that we're in right now, and with the election coming up, there's going to be some changes ahead. So we want to make sure, again, just stay focused on that long term if we can. It's times like these that this is the first time in history that we've all been faced with the same situation in terms of, our change in pattern, our change in consumer spending having slowed down. We're not going out as much. We're not spending as much as consumers. And it's a really big opportunity, actually, to, maybe adopt, on a longer term permanent basis, some of those probably good spending habits that have now entered into, our norm. So for example, if we're not going out as much, what are we doing with those extra dollars that we had been spending on, entertainment and eating out, perhaps? Can we redirect those to debt reduction or building emergency savings? These are all questions you want to really examine. So Today we're going to talk a little bit about, some of those different ideas and those different strategies that you can adopt for yourself. And then ultimately, if economic growth happens, if you do have a temporary layoff, making sure you have those emergency savings. And if you don't, try to focus on it the best you can, so you do have a safety net and a cushion in those cases. So those are important. So again, things to avoid. As I mentioned, I'm wondering, and I'm just curious if there's anybody on the line who in March, when they started seeing that market take a downturn and you're hearing all about the gloom and doom, did anybody take any action and sell out of their portfolio? I'm just curious if anybody did, and if you want to privately chat it to me and say, I did, or did you make any adjustments? I'm very curious to see if you did it or did not. So bottom line is, when you buy into your investments, remember you have shares of your investments. We want to make sure you stay the course, because once you sell, especially when the market's down, you've locked in your losses. And so we find that, you have to guess right 74% of the time in order for you to benefit from market timing. That just doesn't happen. I don't know. I don't have a crystal ball when the market's up or down, but I was reading just the other day. Oh, so it looks like somebody actually said they did not sell, but they bought in good companies that took an irrational nosedive. Okay, that's pretty smart, and probably you've seen quite a rebound. Somebody else said, no, I actually made a riskier. Oh, I bought Apple and Tesla. Well, that's interesting. All right. Okay. So that's interesting. So a lot of folks on the line seems like that you would realize that this was an opportunity. So I applaud those that perhaps ended up buying. So so that was actually a good thing in a lot of cases. Now we want to be thoughtful and strategic about it as well. So what I've done here is I've actually incorporated some timely fixes to your portfolio. These are things that perhaps you're worried about and that you've been affected by. I recently received my Kiplinger magazine, which I use every single month it comes in. I always get something useful out of the magazine, and if you haven't subscribed and you like money and learning a little bit of something every single month, you may want to subscribe to that. But this was actually in the last issue, 7 timely fixes for your portfolio. First one, you took on more risk than you can handle. So these are things to think about. If you are some of those, one of those folks that did indeed take on too much risk. So, many investors said that they could stomach a 20% or more decline in their portfolio, but when it actually happened in February and March, some are realizing that they really don't have the risk tolerance that they thought they did. And so the S&P, fell, like I said, 30, 37%, upwards of 40% between February 19th and March 23rd. So a real strong driver of your time, of your risk tolerance is the time horizon. So, knowing when you are going to need that money is going to be a real big driver as to how you indeed manage that risk. So, the other thing to think about is you try to time the market. So the worst return for an all stock market portfolio, all stock portfolio in a single calendar year going back to 1950 was a loss of 39%. In 2008, according to JP Morgan Asset Management, the worst 5-year return was a loss of 3% annualized, and the worst 20-year return was an annualized gain of 6%. That doesn't sound so bad, does it? And that's kind of illustrating the point that, again, don't bother trying to time the market. To further illustrate, Bank of America security strategists looked at the S&P 500 going back to the 1930s, and since then, a long-lived investor who sat out the highest returns days per decade would have cleared an unimpressive 17% through August of 2020, as opposed to someone who stayed in the market would have gained 16,000%. Can you imagine? Okay. Wow. So that's pretty impressive to think about. So that said, something to think about is you're not diversified. So the way to distribute your dollars among different asset classes is, again, driven largely by your age, by your risk tolerance, your goals. All of that plays into it. And of course, the younger you are as an investor has the most time to recover during those blips in the market, and you can afford to take on more risk. Obviously, those folks who are closer to retirement or who have short-term cash needs may need to play it safer. So thinking about that as well. The other thing is, I'm seeing you're overinvested in your employer. That may not be a scenario for you where, but it's spouse or partner, perhaps they have employer-based stocks. Your income disappeared. So meaning if you have, someone who is already drawing income from your investment program, from dividend paying stocks, and the dividends start to seize up, those may have been problems. So you may need to adjust. And then finally, last two, you're paying too much in fees and expenses. So for example, I wanted to give you an idea of what I mean by that. So avoiding paying high fees may be the single most important decision that an investor can make. So an investor who has $100,000, who generated a 6% return for 20 years, but also who pays a 2% fee, will end up with $214,111 after paying a whopping $62,349 in expenses. If we were to have cut the expense from 2 down to only 1%, the resulting savings would be nearly $28,000 in cost and nearly $50,000 more in their account. So fees and expenses do matter. I will mention a lot of times if you've got previous employer plans, IRAs hanging out there that you're thinking about consolidating, it is an option, and you definitely should look at that. Because of the size and scope of the Maryland Community College system, and of course Prince George's Community College in particular, you're getting the benefit of very low cost options built into your plan. And then finally, many times people have inadvertently bought into scams. And so they thought they were buying a really good option, but we find that people perhaps, they bought into different companies who made claims about COVID, benefits and things that they're on the cusp of cutting edge in, technology and cures and things. And so those items didn't pan out. And so they may have lost money there. So I did want to make mention, that these are all some concerns, and there are ways to overcome these quick fixes, as we were mentioning. So yes, so the question was, what is the magazine? The magazine is Kiplinger's magazine. It used to be called Money magazine. It's not a free one, but I think it costs like $16 a year. I might have had a special deal on it, but I love it because there's always something in here that's relevant to just the average consumer, or somebody who just wants to be a little bit attuned to their finances, and I always grab something that's useful out of there. So thanks for the question. Another question came through, what advice to keep your money in the money market account now? I think the question is, will you advise people to keep money in a money market account right now? So a money market, if you're not familiar, is a cash equivalent. It definitely is going to be on the more conservative, very, very low yielding side, and especially since we're in the lowest historical times when it comes to interest rates, money market may not be a very good solution at this point in time. So really keep in mind your long-term goals, and unless there's a particular reason why you have it in the money market, then I would definitely make sure that you're invested based on your particular risk tolerance. So thanks for that question. This chart illustrates the risk of market timing, and as you can see, if you were to try to time the market, if you sold and then waited a year to get back, then which is the dark blue line, you greatly underperformed someone who stayed the course and and basically stayed invested, which is the light blue line. And if you had gotten out of the market altogether in the green line, wow, you can see how much that individual, has less in their portfolio. So I'd like to stress the idea of risk. A lot of times I've had people say, well, gosh, I wasn't risky at all. I put all my money in the fixed annuity account, which was yielding 3.25%, and I didn't lose anything. Well, the reality is they absolutely lost because, their account is stuck right around $56,000, as you can see, because they chose to go ahead and get out. Whereas the person who stayed the course, wow, can you see what a big swing? And hopefully that strongly illustrates the point to just stay the course, make sure you're diversified, meet with someone to reinforce some of those strategies and make sure of what you have, and making sure it's appropriate for you. So I think that's a pretty powerful illustration. I really like the way that lays that out. So, keeping that long-term perspective is probably the best advice that I would give to anyone, including, myself. I have not made any changes. Granted, I'm 20 years away from retirement plus at this time, but really it's a healthy attitude to just stay the course and check in maybe annually, even for that one-on-one meeting with a financial consultant, or adjusting your portfolio, perhaps using some of the online tools. Or if you like the idea of using life cycle funds, kind of that set it and forget it mentality, to know that that one portfolio is invested, based on your age. It's more aggressive now, becoming more and more conservative. That's kind of an easy set it and forget it way to approach your investment strategy. So something to think about. Heading into the recent crisis, the U.S. economy was healthy, as you all know. So, the recent downturn that we faced earlier in the year with low unemployment, originally, consumer savings rates were at their highest in nearly 20 years. So now, things have taken a certain change. We need to be conscious of how we're adjusting and how we're adapting. It may involve, in some cases, if perhaps we've gotten layoffs, or we've had reductions in pay, or things have changed, we may need to adjust our plan. Individuals who plan to retire at 65, well, all of a sudden, maybe we need to defer and retire at 67. So these are all things to really think about and be conscious of. So the other thing to think about is, first things first, do you have an emergency fund? And if so, how much do you have? How much do you have set aside? Ideally, you should have about 6 months worth of emergency savings. And if you don't, then that's definitely something to strive for. I encourage even upwards of 9 months of the different investments to be into your plan. So if you don't have, say, 6 to 9 months worth of emergency expenses set aside, then what are you doing? How can you overcome that? Well, one bit of advice is to set up a separate savings account that's perhaps outside of your primary banking, right? Typically speaking, if you have a primary bank that you deal with and you have it linked to your checking, it's a little bit too easy to tap into those dollars, right? You can do a real quick, simple online banking transfer. Oh, I'm just going to take $100, just need it for this or that. If it's too accessible, then it may be undermining your goals of trying to build up that savings. So if you're ever interested, TIAA actually has a bank, TIAA Bank. We're paying some decent rates right now, and it will show up if you are working with TIAA right on your website. So you can see your retirement plan, you can see your banking, you can also network in other accounts through the Financial 360-degree tool. So just a couple of suggestions. So we want a buffer in the event we have a job loss, emergency car repairs, medical emergencies, right? All of these things, and not have to try to tap into our retirement, right? Sometimes I've had people who, just have no cushion. They don't have perhaps a home equity line of credit. They don't have emergency savings. They don't want to necessarily do a cash advance on credit cards, and they're in a real pinch when it comes to that. So really plan ahead and be deliberate about that. Also having direct deposit going ahead and dedicating $50 a pay or 75 or whatever you can swing to send direct deposit to that outlying account may be a really good strategy. So something to think about. Now, how can we build that emergency and dedicate those dollars to where we know when we just feel like we just don't have the extra money? Well, you can either earn more or you can find the money by saving on your expenditures. So what I was saying before is that we may all be finding that we're spending less going out. This is maybe a great place for you to dedicate those extra found dollars. We can also perhaps earn more in other ways and, and perhaps offer our services. If we can earn any extra money, maybe put them towards any debt that we might have. Typically, if debt is 7% or more, you're going to want to focus on getting that paid down. So these are some different strategies that we can help you work through. We have a new tool. If you go to tiaa.org/tools, that you can actually utilize our debt reduction calculator. So it's extremely useful as well. All right, so in a few minutes, I'm going to actually go into the idea and concept of diversification. But, if you look at this chart, you're going to actually see that, around the early 2000s and also stemming back to the low point in 2009, you can see that 100% stock portfolio fell the most. And it didn't really gain that much more, all said and done, than a portfolio that was more balanced. So if you see some of these other portfolios, portfolio 2, 3, 4, and 5, which is kind of a mix of stocks and bonds, it's not a significant swing given the risk. So I think the point there is that, you may want to consider a more balanced portfolio because there's an inverse relationship between stocks and bonds. Right now, we're in a low interest rate environment. So the lower the interest rates, the higher the performance in the stocks. As interest rates start to rebound, typically your stocks start to decline. So if you have some of each, then again, they tend to be a counterbalance to your overall portfolio. All right, so the idea of different risk, investment risk, volatility, diversification, and I think we talked a bit about expenses, so we won't go into that too much. But basically, the idea of investment risk is the risk of losing the money that you invest for whatever reason. So that question had come up earlier today on a different presentation. Hey, if I get started, what's the guarantee? Do I have any assurance that my money will be there when the time comes? And the answer is it'll be there. It'll be there in some fashion because remember, you always have the shares of that particular investment. They're not going away. So, over the course of time, they're going to go up, they're going to go down, but it could be something related to the economy, political ramifications, investor sentiment, variety of different things play into the market ups and downs. Same thing that said, volatility is a measure exactly of that, of how much an investment moves up or down over more of a short period of time. So it could go up or down considerably, at any point in time, but, weathering that and also making sure that you've got the appropriate type of investment can have a really, solid effect to buffer against that volatility so that it's not a bad thing. So, as I reflect back on what you all had said in response to one of my questions, you guys had seen earlier in the year how we were faced with a huge swing of volatility to the tune of a 35 to 40% loss. A lot of you bought in and ended up buying more shares or investing further. So that was actually a prudent measure at that point in time, an opportunity. The other thing is diversification is really the concept of spreading your investment out between various asset classes. So having, different large cap, mid cap, international, and making sure that you're allocated accordingly. If you also go to tiaa.org/tools, you can take a look at some of the tools that we have, an asset allocation calculator. We also have another cool tool called Retirement Advisor, and it will actually give you specific investment recommendations at the end. So it actually will give you recommendations for the Prince George's Community College plan, which is pretty awesome. And now that tool will steer you away from the life cycle fund in favor of the pick and choose strategy, but it will basically determine if you're an aggressive investor, moderate, conservative, etc., and also make the particular recommendations. If you say, wow, that looks great, you can actually click a button and implement those updates. That's really easy and friendly to utilize. Now, the other last thing here, I think we talked a little bit about it, but that idea and concept of investment expenses, those are always netted out of your earnings. So, even though when asked the question, for 9 out of 10 investors, when they're asked about the investment fees relating to their 401k or 403b, most of them, 9 of them out of 10, 90% of them say, what do you mean fees? I don't have any fees. I don't see any fees in my plan. The reality is you do have fees. They're all baked in a lot of cases. They're not outward. You wouldn't know them unless you start to dig a little bit, but it is important. If you have outside investments, old 401ks, ask the question. If you have an advisor, how are they getting paid? What fees do you have? Do you have annual fees? Do you have any sort of custodial fees? These are all factors that's going to erode the balance that you have in your portfolio in the long term. So really ask for those disclosures. Here at PGCC, you should receive what's called a 404A5 notice. Again, a 404A5 notice from your provider, and that should be annually, which discloses the cost per $1,000 invested, how much it costs you to own various investment programs. So interest rate risk, inflation, these are all the various types of risk, but risk is not a bad thing, not at all. There is inherent risk in putting your money under your mattress in the sense that it's not going to grow enough. So we really just want to be thoughtful and forward thinking about those different types of risk. Are there any additional questions as we're moving along here? Glad to see so many participants. I'm really excited about that. So thank you for that.
Lisa, I have a question.
Yes, please.
You mentioned that if you're going to jump in and out of the market and play the market and the ups and downs, you have to be right 74% of the time to break even. Is that correct?
That might have been my number. I'm not sure. I have to refer back.
Yeah, you said 74%. I was wondering, what formula did you use? What goes into that? Is that just taxes and commissions, or?
No, I think the alternative, it's more thinking about the opportunity cost, about the likelihood is that you're not going to hit the mark, and that we don't have a crystal ball, so we don't know. And in order to be successful, you'd have to hit the mark, which is,
well, let me put it this way,
really impossible. Yeah.
Why is it not that to be successful, you have to be right 51% of the time? Why is it 74 rather than 51?
I was referring to my Kiplinger magazine article, so I'm referring, that was kind of my reference point for that particular statistic. But I think the bottom line is the alternative would be to stay the course, right? So if you're an aggressive investor, stay the course, be an aggressive investor and continue saving. Whereas if you're someone who's trying to like sell down, sell high, buy low, sell high, buy low, the reality is you're probably not going to do it. And so you're better off to just stay the course. I'd have to look a little bit more closely to give you a firm answer otherwise.
That's good. That's a good answer. Very much.
So yeah, definitely. So, all right. Thank you for that. All right. So as you're thinking ahead, make sure that you're invested appropriately at the right time. And as I mentioned, even having a balance of bonds and fixed investments alongside of stocks for someone who's aggressive may not be a bad play. You can have 85 or upwards of 100% in stocks or equities once you have a 10 or more year time horizon, denoting that you're aggressive. And you'll see here, obviously, these are not all available by any means in your Prince George's Community College plan. However, you can get a feel for what we mean by asset classes. So different investments carry different levels of risk. And of course, stocks are always on the upper side, bonds are always on the lower side, and then you see a variety of other options built in. Generally speaking, moderately aggressive is when you're 7 to 10 years away from retirement. Moderate is about 5 to 7. moderately conservative about 2 to 5, and then conservative being 2 years or less or retired. So even somebody who's retired, you'd still want to make sure you're invested in the stock market. You don't want to completely, sell out. So you'd have about 80% into bonds and fixed, 20% at least in the stocks. So the other thing you want to do is we want to diversify across those different asset classes. So by example here, you can see equities on the upper side. So, it's not enough to say I'm going to put 85% in equities, but rather you're going to say, well, of the 85 I'm going to put in equities, I need to put 25% into large cap value, 20% into large cap growth, mid cap value, mid cap growth, right? Down the line, small cap, emerging, international, right? And that's where we're kind of getting that diversity within that equity class category. Same thing with real estate. If you don't have real estate, you may want to think about having generally upwards of 7 to 10%. In there at TIAA, we do have a real estate fund. It's an owned portfolio of our TIAA owned properties. So it's pretty exciting. Fixed income or bonds are also available. Money market, that I think somebody was asking a little bit earlier about how that operates, and is that a good place to be right now? Tends to be very short term, very conservative. It seeks to maintain the value of $1 per share, so it may not be a good long-term solution unless you have a real reason to be there. You're otherwise better off to go ahead and invest in various investments. And then finally, guaranteed, particularly here at TIAA, since we're an insurance company, we do offer a fixed annuity option known as our TIAA Traditional. And so with that, it does offer a certain minimum guaranteed portfolio and return, and it does not necessarily tie with the stock market. The rates are declared quarterly. So it tends to be a real nice foundation of income, and it can be turned into kind of your own personal pension through the use of an annuity down the line as well. So something to think about. So we want to make sure you diversify among those classes, and this is kind of illustrating my point. So have large cap, mid cap, small cap, etc., as a way to kind of capture the upside, limit your downside in the long term. So the number one thing and determinant of portfolio performance is asset allocation. Do you see that? So it's having some of everything at any given point in time, because it's going to help, again, capture the upside, limit your downside. Other things that we can do, kind of stemming back to that idea of trying to moving target, hit the mark, over the course of time through market timing, it's likely not going to happen. So picking the right investments, that plays into it, but that's not a strong driver. And then other reasons. So number one thing, diversify and just have the right allocation at the right time. I really like this illustration. So bottom line, the other thing you can engage and adapt onto your portfolio is what we call rebalancing and making sure to reallocate to your original mix. So here's an example. Let's say you originally set out to do 25% into each of these 4 target allocation classes. Over the course of time, let's say hypothetically, US stocks were to do really well in a given year, and now that 25 has grown to 45%. Ideally, you'd want to rebalance that portfolio to the original mix to capture that growth. Now, logically, you'd say, well, gosh, if US stocks are doing so well, don't we want to let it ride? The reality is no, because the likelihood is that next year, US stocks will not likely be on top. Maybe international is going to be on top, and now all of a sudden, it's skewed. Your portfolio is skewed from what perhaps it was originally. So we want to go ahead and scrape off that growth and lock it in so that you have that for down the line. So something to think about. And that is available. There's no extra cost or anything like that. If you go through that retirement advisor tool I was mentioning, you can actually select that you would like to rebalance it as part of that. Obviously, there's no cost, and it occurs on your birthday as your new anniversary date. So wanted to think about that. We're rounding the bend, so I'm going to go ahead and skim through these just a little bit. So mutual funds are now available through your portfolio. They are an opportunity for pooled investments, and beauty of having, again, the Prince George's Community College Plan, you have the optional 403B as well as the optional 457 available for you to save in. You can double up, and all of the investments are either mutual funds or variable annuities that operate as an accumulation vehicle. There's no extra cost, but it's a great way to pool your investments and get a lot of bang for your buck if you want to look at it that way. So we're going to kind of keep that in mind. Now, the other thing that you're taking advantage of is payroll deduction. You can buy into what's called dollar cost averaging. So you're averaging the highs and the lows of the market and kind of stemming back to our original idea of investing in certain times. This is going to average more favorably if you buy over 26 pay cycles or 12 pay cycles versus somebody who plunks their money in all at once. And this is going to giving you a idea of that and how you end up generally with more shares maybe than you would have otherwise. Again, since we don't know which day is going to be favorable and which day is not, we can just average in more favorably overall. And then one final thought and takeaway, and I know that we're wrapping up at around 2:55, but if you're not familiar, the idea and the concept of an annuity, just wanted to take a quick moment about this. So one of the nice things about as you're thinking ahead is the money that you're saving away. Let's say you're in the optional retirement plan, so 7 1/4 is going in for you. Otherwise, you may have a pension, so you have kind of that future benefit that you're looking forward to. Aside from those two solutions, you also should have your own voluntary money that you're saving away, right? And this is going to be an opportunity for the dollars that you accumulate in your plan. You can choose to turn them into lifetime income. For example, if you should choose TIAA, that's one of the big things that we can offer. We do it extremely well. You can do that through a deferred annuity. So basically your 403B or your 457 is a tax sheltered annuity. It's an opportunity to save, right? And then the time that you turn around and are ready to retire, you can then decide if you would care to annuitize or turn those dollars into a stream of income to effectively then replace your paycheck when the time comes. So that's an option, which would be a real nice complement to perhaps Social Security, perhaps to any other pension that you might have, to give you a solid foundation of income. It's an option. You don't have to do it, but if you choose to, again, you can turn that money into that income opportunity. If you don't do it, then the general rule of thumb is whatever you've got saved away, the most you'd really want to think about drawing is 4 to maybe 4.5% off of that principal. So if somebody who has $1 million saved away, they're not going to want to really tap any more than $40,000 to $45,000 per year to assure that they don't bleed down that asset prematurely. So definitely something to be thoughtful about as you're thinking ahead. So here's some tips and takeaways. So if you're not on track, I mentioned it before, find the extra money. If you haven't done so, have a plan. Meet with a financial consultant, and we can talk through what your goals are and give you some little backdrop to know if you're on target. It may involve you working longer. It may also involve you spending less in retirement, meaning, maybe you have to reduce your expenses. Maybe you have to downsize your home, move to a lower cost of living area. Possibly, these are all the things you want to think through. Reduce or push out other goals. I've had other times when people have plans to fully fund their child's college education, all with the best of intentions, but then they realize that they're also behind in their own retirement saving, and they realize that something's going to have to give. And so my general advice would be to, maybe reset the expectations for college so that you can indeed focus on your retirement. You can borrow for college, you can't borrow for retirement, right? So these are the thought process we can help you to think through. And consider the ideas of lifetime income, and then again, utilize some of those online tools that may indeed be useful for you. So, so with that, I'm going to go ahead and kind of share a few takeaway tools, open it up to some questions, and then maybe in the final couple of minutes that I have, I might share with you a couple of resources as well. So I'm going to leave this slide up here for a quick moment. TIAA.org/PFR is extremely useful. But otherwise, if you have an interest in unmuting yourself or else chatting a question through, I would certainly welcome you to do so. Okay, so I had a question about index funds. What does TIAA have? Any that are similar to the Vanguard Index 500? I would like an average annual interest rate above 8%. All right, so thanks for that. Actually, I think that will be my cue. Let me go ahead and finish up here. Takeaway items, final thoughts, maintain an emergency fund, make sure your portfolio is diversified, stick with your plan, reevaluate, and certainly check in. These are definitely things to do. So let me go ahead and share my screen. I'm going to do a new share back to that question, and I'm going to go ahead and share the microsite. And what I did here is I went to TIAA.org/Maryland CC. If anybody is already with TIAA, you'll probably be well aware that there were some updates that are being sent your way. You would have received a notice about the ORP plan changes. So there are some updates that are coming, including a change of fee structure in the funds. CREF growth, CREF stock is going away. So I just wanted to point that out in case you didn't know. We do have some index funds that are available. So let me go ahead and share those with you while we're on that question. All right, so I'm going to jump over here to investment options. You can see all of them publicly on this website, or if you already have a plan, you can also see it under your login. And let's go ahead and see those investment choices. Okay, so the top tier, you can see there's a variety of retirement choice, which is the annuity plan, the ORP plan, if you happen to have that with us. The old plan is listed here, the GSRA, and the retirement choice. So this is actually the supplemental plan, the rate that's paying. If you have the ORP, then it would be here. If that's assuming that you've chosen the guaranteed. If we scroll down, there are a nice variety of different investment choices, and we do indeed have some index funds, in fact, that are offered by Vanguard. So let's take a look at that. We've also got those life cycle funds that I was sharing with you earlier. If you like the keep it simple approach and you like them being managed for you. And let me go ahead and look at the end here. So Vanguard is the ones that usually are offering those life cycles. So anything that you see index built into, so you'll notice in fact that all of our TIA life cycle funds are index funds. So they're not actively managed, they're indexed. So if you look below the surface, they're comprised of 4 underlying indexes. And then you'll also notice that there's the small cap index. Anytime you see the word index, and of course, Vanguard index. So in answer to your question, yes, we've got a whole bunch of index funds. Any other questions? All right, so as we move down the line, for the dates when payroll deductions are made, what pricing normally applies? The start of the day, end of the day, or variable? Okay, so good question. So I'll just go ahead and select one of these investments to show you. So for example, if you should invest in the CREF stock, let's say hypothetically, the price per share is as of the end of the day. After market closes, then what they do is they calculate the outstanding number of shares, divided by the market performance for the day, and that then dictates the price per share. There is no intraday trading of mutual funds, so we don't know in advance, of what it's going to be. So that hopefully that answers your question. It's not traded like a stock an individual stock would be. So in this case, this was probably a bad example, but the Cref stock is trading for $584.41 a share. It went down by $10.70 as of yesterday's close of business. We don't know until after business closes what it ended up for the day. This is actually showing your investment expenses. And then, you can actually see all of the underlying investments, the risk reward, spectrum. This is considered a large cap blend. And then if we look down here even further, this is the part that I always feel like is really interesting. These are the top 10 holdings: Apple, Microsoft, Amazon. So this is what's called an actively managed investment. And, you're actually buying into those underlying companies, which is pretty cool. All right, any final questions or any inquiries? Because I think we're rounding the bend. And I believe I gave authority to unmute everyone if you wanted to do that. You're welcome to do that as well. All right, so if I don't have any other questions, I wanted to real quick show you while I have a quick moment. If you're thinking about TIA or you're already with us, we're really excited about that. We're here to serve. This is actually showing you your account and how it would look. You may not have that much in your account and your name may not be Ann, but other than that, this is kind of what it would look like. And you can kind of see, a whole lot of information here. I did want to share that you can go here to resources if you've never done that once you log in. And there's a few things to point out. So the tool that I was mentioning to you, the retirement advisor tool, very useful, 10, 15 minutes at most. You can get answers to, am I saving enough, on pace, allocated properly, very user-friendly. Here, if you would like to get more in-depth ideas about your payout options, you can click here as well. And then finally over here, you can actually see all of the tools and calculators that I was sharing with you before. Maybe life insurance is a concern, income, things like that. You can see that. And then also variety of topics that might be useful for you are there as well. So I just wanted to point that out. And then additionally, if you were interested in banking, like to open up a savings account, we can help you there too. And the last thing I wanted to show is right here. I was mentioning it before. If you're trying to get a handle on your household finances, you can network in any account that you have a user ID and password for. Very user-friendly, and that way you can get a holistic view of what your household finances look like. Definitely, very user-friendly and useful. Okay, so I think that might wrap us up. And if anybody has any final questions, I already chatted through my name and phone number and email address, so I would welcome anybody to reach out. If they have any questions, I'm really excited to see so many participants here today. Really excited about the turnout, and I'm hoping that you're, getting a lot of benefit out of your professional development day here at PGCC. So we're really excited to serve. Whatever you do, do one thing differently. I lied. There's one more final thing I wanted to show you, as maybe some of the folks didn't catch it on that weren't logged in the front end. If you're interested in scheduling an appointment, you can go to tiaa.org/schedule now. And when you do that, you can either select your employer. Given that we have limited dates that we're offering, and we may not have any available dates specifically for PGCC, we encourage you to actually go over here to virtual consultation. Our local offices are closed at this time. So if you select the local office, our PGCC virtual meetings, then you can actually see all available in the next 30 days. So you can see we have quite a variety of different times and dates that might be convenient for you. And of course, all the consultants are versed in the community college plans. Okay. So thank you guys so much. I'm here, we're here. If you have any questions at all, let me see if there's any final information. I'm gonna go ahead and chat it to everyone again. My name is Lisa Fulco. Lisa, whoops, I'm trying to type and my caps lock is on, Lisa Fulco, and it's lisa.fulco@tiaa.org. If you're interested in trying to reach out or have a question or are interested in consolidating and wanted to know, how do you go about doing that, all the things I can help you with. So thanks a lot. Oh, thank you, Nicole. I appreciate that. All right, guys, I'm going to stay on the line. You can drop off because I'm sure you've got your next session, but thank you again for taking the time and jumping into today's presentation.
Thank you.
All right, thanks a lot.
Thank you.
Thank you. Appreciate it.
Thank you so much.
Thank you. Thank you, Jaron.
Thank
Yes,
you.
yes. Thanks a lot. I appreciate it. All right, so excited to have such a nice turnout. Wonderful.